Yeah, let us get started. So anyway, I'd like to say again, thank you everybody for being here so much on this Saturday. So we're going to dive in today. Got earnings season kicking off next week with the big banks. So I want to go through some different strategies that are low risk that we can use in this kind of uncertainty when we hit around the earnings season. So again, thanks for being here. And I love these Saturday events because we can, the markets are closed. We're not distracted by all the different things that are going on as far as the markets moving and everything. So again, thanks for being here. And we're going to dive into, an earnings interactive workshop. So if you have questions, feel free to ask. If I miss your question, a lot of times, with GoToWebinar, they'll roll off, so I don't see them. So, put them back in, and I'd be happy to answer those questions. So, a little background on myself. I've started my trading journey back in the 80s with a company called Coastal Corporation. It was a large integrated oil company, and they actually had at that time, they had a training program that they would take in young guys like myself and teach you how to trade oil and oil products. And so it was a great, really a great, advantage that I had there to get my foot in the door, and just a great introduction to the trading world. So I started there. They sent me out to the refinery. They had a big refinery down in Corpus, Texas, and sent me down there for about 3 months. So it's really great because you kind of learn the foundation of oil, coming in from the tankers and the processing of it, turning it into different products. So it got you grounded as far as that. And so shortly after I got back on the trading desk, they sent me out to Singapore for a couple of years, and fantastic experience. Traded, learned to trade a lot of the Asian crudes and the different products. Trade a lot of fuel oil and MoGas, things like that. And then got a job at this company called Transworld Oil. So back in the mid 80s, at that point in time, they were Transworld, Fibra, and Mark Rich were the three largest oil trading companies in the world. So that was a really exciting turn of events for me and really kind of launched my career. So spent about 17 years with Transworld. Sent me out to their Bermuda office where was corporate headquarters, and spent about 16 years there. Ended up running the international trading desk for about 10 out of Bermuda. So we were pretty much into everything. That's where my option careers started back in the about 1987. We started trading options on cargoes of crude oil and never looked back. So we had to learn on the run. So it's been a constant learning journey ever since, but we were into everything, all the different futures markets, foreign exchange. So it was a really great learning experience. So hopefully today I can pass on a few things here on how to trade earnings and some of the different strategies that we can use there. So again, thank you so much for being here, and sorry for the short delay here getting started. So the following presentation today is purely for educational purposes. Any stocks, futures, or options mentioned does not constitute advice and should not be construed as a recommendation. Have you ever really noticed how earnings sometimes are just horrendous? The stock goes up, or they can be, look like they're off the charts fantastic and the stock tanks. This is kind of what I call the earnings confusion. So when a company has an earnings conference schedule, many times there's going to be speculation not only into the accuracy of their projected earnings, like their earnings per share and their revenue and other factors, but they could be making announcements of layoffs or buying another company or adding, something to their corporation, or, some big event that the market wasn't aware of. So it can be a really big surprise during that earnings conference call. So it's this kind of typical uncertainty that causes an increase in the volatility of the shares of a specific company that's reporting, and that's kind of the big diamond in the rough. This is a temporary parabolic rise in this volatility that spikes option prices higher. Now, traders tend to, when earnings season comes up, they'll tend to stay on the sidelines, going into the days leading up to the earnings conference call, because it's so darn confusing and sometimes scary. Now, call buyers, though, will then end up a lot of times swapping out their shares, reducing their risk, but still want to stay long to participate. So they'll start, rolling into call options so they can, still participate in a rise should the, shares move higher after the earnings. But they also want to be limited to potential loss should the shares trade lower. So there's this big surge in volume there on the call side. Now, there's also additionally the put buyers that force option prices higher as they try to protect their positions from any downside movement. So it's all this concentrated option buying in many cases that will drastically expand the volatility levels of stocks being traded into their earnings release. Now, as an individual trader, then we can take advantage of this uncertainty and volatility to capture profits, no matter what the crazy earnings reactions are. You just need to know the right setups to use. Now, as an individual trader, you can take advantage of all this no matter what. So you just need to know those setups. Now, step one, first thing you want to do is you want to identify and qualify a particular stock, by looking at its past earnings performance and looking at the probabilities of certain things happening as it heads into the earnings release. So there'll be sometimes consistent patterns with the stock as they, head into their earnings or even at the earnings release or even after. So we want to look at that first. So then we want to find and kind of quantify, put like a bucket of different stock in different what I call buckets of things that can happen. And so we want to find those stocks that have certain things that happen. And then we also want to use and look for those stocks that are, releasing during an earnings week expiration. So we want to take advantage of the weekly options. Now, step two is, evaluating that past performance. So we want to look at the volatility to see what it's done previously to the stock as it moves closer to its earnings release, the release date, and even after. So this is a very important step into, finding decent earning trades. Now, the prepared trader then is going to look for that dramatic increases in the stock's volatility as it approaches its earnings release. Now, stock volatility normally runs between anywhere from 25 to 40%. Some of the, really high volatility stocks are going to be higher, but normally that's kind of the range. But with the weeks of the leading up to earnings, its volatility can easily move to extremes over the kind of the normal volatility levels of a stock. Now, this can really make a stock a potentially great profit opportunity. It's this volatility that sometimes can, double and in some cases even be more extreme than that. So this is what we want to look for in order to take advantage of and give us the opportunities for different types of trade setups. So here's kind of an example. Here's like NVIDIA, and look at this. This is back when it was traded at $270, but this is just going to show you the volatility and how it changes and what happens. Now, this is the implied volatility in this example going one day from its expiration. So NVIDIA typically reports its earnings on a Thursday after the close. So here it was the day of the earnings release, okay, before the close. And at that point in time, you can see the implied volatility on this series was over 114%. Now, normal implied volatility, back here, when NVIDIA was trading back in this time period was around 45%. So it really spiked up as it was going into the release date of this Thursday after the close. So this was signaling here that there was a potential that NVIDIA could go up $17 or down $17 just that one day period. So that would be like just a one standard deviation move up or down. So a $17 increase up or down. Now, NVIDIA, going into the expiration or into its earnings series was trading here at $270. So the next day, though, after the earnings release, you can see that the volatility crush hit, and now you can see what happened to the implied volatility. The implied volatility totally crushed and collapsed back down to kind of the normal implied volatility rate. So it had jacked up to 114, and the normal rate was 35 to 40, and so that volatility just totally came out of it. So that's volatility crush. Now, not only did that happen, but NVIDIA spiked up to the price of $291. So that was also a 7.5% increase there. So two different advantages to potentially take advantage of would be the implied volatility crush that collapsed there from 114 and potential, a price spike to grab that price movement to the upside on NVIDIA of 7.5%. So you can see here it went from 114 after the earnings release. The next day it was down back to the normal area. All the uncertainty was then taken out of the stock. So that's a very typical thing. So here's NVIDIA, it's trading right here going into the earnings. And the earnings, you can see the implied volatility here, this teal line was, moving up, spiking up, and then the earnings were released, volatility totally collapsed. But not only did that, we had a price spike to the upside of 7.5%. So these are all the different things and opportunities potentially that are there to take advantage of. Now, for this very reason, it's essential to have then a watch list or a bucket list, kind of what I call, of different stocks to monitor closely due to the fact that they're not all going to present an equal kind of trading opportunity for an earnings trade. So the goal is to take advantage of the temporary rise in the volatility as well as the past earnings performance for different probability events that can happen, either a stock having a big spike up or price going nowhere and volatility collapses. There are different things that we can take advantage of. Now, there are three types of earnings cycles as well. So you can have the cycle one is where you have a trend trade into the earnings, where the stock is kind of trending up or down as it enters into the earnings release date. So that's kind of the trade, kind of cycle one trade that you can potentially have. Then the second one is the actual earnings release trade itself. And these are non-directional because we don't know if the market price on the stock will go up or down. So there's certain strategies that we want to take advantage of that are non-directional. We just don't care. We just need either a big movement or no movement at all. And then the third is some stocks have a tendency to trend after the earnings release. So these are three types of trades that you can kind of look for, for specific stocks. So here's a really good example on CRM, which actually in this series had all three. So you can see it was trending higher. The price started trending higher. And typically you'll have these trends anywhere from 1 to 2 weeks out typically. So you can see here, this was even longer, but you can see the price started trending up on CRM. Now CRM was having its earnings date here, about the May the 18th or so, and it started trending up here at the mid part of April. So first thing that happened was price trended, but also the implied volatility, the teal line here, started trending up because of the uncertainty as to what was going to happen that day of the earnings release. So the thing that happens here is, number one, you get the price moving up. So that's going to increase the price of your options in that particular option series. And then two, the implied volatility is moving up. So these two components of a price of your option are really pushing the price of your option up. So that's a really great way to take advantage of, a pre-earnings move into the earnings release. But you always want to be out of that trade before the earnings release, or at least understand then what can happen. So then the next trade is, okay, you get the release of earnings and that thing could spike up or down. So that's where we can take advantage of certain non-directional option trades to, take advantage of price spikes up or down, or no movement at all. So you can see here, once the earnings were released, the implied volatility collapsed, but also price stabilized. And then that's the third potential type of trade, is a post-earnings trend trade. All right, so trade two, again, just to kind of review that, is the earnings release trade where the price can go, spike down and up or down. And then trend trade three is that post-earnings trend trade. In this case, it started trending back up higher. So these are three opportunities that you have on various stocks, and it's just a matter of looking at the earnings history and doing your homework on the analysis to see if there are any consistent patterns to specific stocks that might lead you to one or two or all three of these types of trades. So here's another example. Here's Nike as it runs into its earnings. So you can see here a couple different ones. You can see Nike's actually moving down. Okay, price is trending down in this channel, and also at that same time, implied volatility is trending up. So that would have been a really great, powerful short trade using this earnings series here to take advantage of the implied volatility moving up, which moves the price of your options, in this situation, the put value up, and also the price trending down, which is increasing that put value too from that delta. All right, so that's a really good example there. And you can see also here's another one that was back here, and then you have that volatility collapse after the earnings release. All right, so those are very typical of the different things and patterns that you can see from certain earnings type of cycles. So step three then is to use an earnings checklist. So I like to have a checklist. I like to try to make things that's kind of systematized, kind of a trade process. And this really helps you to do the same steps each and every time. But also, if you have a checklist or kind of a trading process, it's going to take your emotions out of the trade and you just make it purely systematic. So with this process, what I'm looking for is a number of things. First, if we're going to trade a certain security, it has to have options. It has to have good liquidity on those options as well. And it must have high pre-earnings volatility. Okay, so that's going to be something we can take advantage of there. Now, the other thing too, must have had past price moves on the average of greater than plus or minus 5% or less than 7%. So I'll go in what this means here in a little bit, but there's certain types of different movements that we can have that we want to take advantage of. And then typically I'll look back at least at the last 4 earnings cycles and even more to see if there's any kind of consistent pattern of something moving less than 5% or less than 7% or greater than those type of percentage levels. Then the next thing too is kind of want to look at only prices, stocks that are over $30 per share. Because if you're looking at earning stocks that are less than that, you don't have enough dollar kind of movement to take advantage of. So these are a couple of different things that I'll put in screens that I'll look for to run various scans. So then I'm going to calculate the implied stock move the day of its earnings release to get an idea of what the market is telling us the expected move up or down would be, which is your kind of standard deviation move of a normalized move up or down. Then from that, I will perform an earnings price target analysis from that implied expected move target analysis, what I call that. And then that will help to give you the things that you need to select the appropriate weekly option strategy, your entry plan, and your exit plan. So these are all the steps that are kind of involved before the trade is ever put on. All right, so those are steps there. ACMI or AKM, we had this earnings trade, and so it was trading here the day of its earnings release, and so this was also like on a Thursday, it was trading around 98.18, okay? And the earnings were going to be after the close, okay, on the specific same date. So you can see, look at the implied volatility. This thing was up to 238% implied volatility. And normal implied volatility, for AKM was around 45. So this thing was just super extreme going in. And this is typical of a lot of various different stocks will have these extreme type of volatility levels. Man, that one is like about as extreme as you get. That was 238% pumped up, and the normal volatility on that is, wow, that's 5 times. Okay, so the normal, here's your standard deviation implied expected move up about 10%, and this is showing an implied volatility of 5 times the normal implied volatility. So huge. So this is just saying that the market's saying that this thing could be up, look at here, $10 up or $10 down the next day. That is just one standard deviation, but past history shows that this thing might have bigger moves than that. So you can see it's really, the market's really thinking something big is going to happen on this. So these are things that we want to take advantage of and look to take advantage of, and if you just know how to do it. So here it was going in again. So it's trading at 98.18. The implied expected move was on a percentage basis for 9.5% up or down, which was over $10. And here it was the next day. You can see the next day on AKAM, it went from, not only did the implied expected move, looking for a huge move, but it also dropped 20%. So it was down at 77.94 the day after the earnings release, and the implied volatility was still high, but it had pretty much fallen off from that 230, so it dropped in half. All right, so that's a good example to show you what you can look for and things like that we're going to take advantage of, and I'll come back to this trade here in a little bit to show you what we did. So here's kind of the earnings statistics that I like to go through to kind of plan out a trade. So here it was the AKAM. This is a certain screen I do, and this was looking for stocks that would have moves of greater than 6% up or down. So just for example, here, this was back on the November 2024 series. You can see the straddle cost here and the implied move. The market was looking for 9.47% up or down. And then you can see here just what it actually did. You can see here the pre-earnings price was 104.40, and then you can see what it did the day close after. So it was down over 14%. All right, so these are things I look for. I look for these statistics to kind of give me an idea of how to trade. You can see AKAM though has potential for big moves. Here it was down 21%, down 14, up 10, down 10, things like that. That's what we want to take advantage of, and we can do that. And I'll show you some of the ways that we, take advantage of those kind of stats. All right, so that's just a really quick look there. Now, the next thing I always like to do is you can really kind of, map it out even better. So this was putting that information into kind of an earnings worksheet to show you in more, detail what it looked like. So here it was that November 24, going into before the close, it was trading at 104.40. And you can see the implied move here before the earnings were released was for this one 9.4. This was going back the August one, 12.66, 9.1, 6.52. All right, so then taking that average, you can see the average move here for AKAM over the last average five cycles was 9.5%. But then what I want to do is what did it actually do at the earnings at the close of the expiration of AKAM in this situation? So you can see this one went out and closed 14% down. The prior one in August of 2024 closed over 10% up, closed over 10% down, 8%, and then here was the smallest one. This was a kind of an outlier based on what AKAM does. So on average, you can see it has big moves up or down. Now I even went back further on this one, went back over 9 cycles, and the average move of those 9 cycles at expiration was for a move, an average of 10.55% up or down. All right, so this tells me a lot. This tells me what to do with AKAM if you want to trade it, or what not to do. And in this one, I'll show you a little bit later the trade setup that we did on it that worked out really great. All right, so that's kind of the stuff that we look at, the stats to see, okay, what does this guy typically do? Now, step 4 is the weekly options, the power of using the weekly options. And this is exactly, want to use weeklies for all earnings trades to take advantage of the 2 really major option pricing components, which are time value and implied volatility, which are the 2 big components that make up the value or price of your option. So the combination of these 2 components, when used correctly, then can help us to create low cost defined risk trades and trading formula for generating some really good high returns in a very short period of time. So I kind of call this like lightning in a bottle. So, if you can bottle up a process that, gives you consistent kind of trades like this, it is, you open that bottle, that lightning pops out, and it can be just like that, pretty exciting. So it just comes down to then knowing which weekly option strategy to use for an earnings trade, how to construct the trade, and then when to trade it, then the weekly options to use and produce some really exceptional fast profits due to the incredible leverage that we're getting that provide us a perfect trading vehicle for these kind of earnings trades, okay? So weeklies are very important. So I'm not going to trade anything with just monthlies. Now it could be like next week as we have monthly option expiration. So, we could trade those in the week of an earnings release. But if, we're trading at a certain stock that it's not in its monthly expiration, it has to have weeklies or else we're not going to trade it. All right, so that's a big part of the steps involved. So the next thing is what I call, which one to pick. So this is then using what I call comparative option strategy analysis. So when constructing an earnings option trade, you want to first look at the risk to reward or the return on your capital that you're putting up at risk, okay? And so this is going to be then, looking at that risk reward between the different various option strategies that you might want to look to use, and then you compare those strategies to pick out the best risk reward for your trading goals. Now, everybody here is going to have a different, parameters as far as their, risk tolerance, for example, or the capital accounts that they trade. So that's going to make a huge difference on the risk reward trades and how much risk you take on a trade. So that's the first thing to do is step through this process, and we'll go through this and show you. You know, there are going to be times when you might actually have more than one strategy that you could actually use on a specific earnings trade. But we're going to do this analysis to kind of give us an idea of that risk reward. Now, step 5 then, you know, is to know, you know, what are the strategies and how do they work? So there are basically 5 different strategies that I'll look at that can capture, you know, profits from extreme price volatility that's going to surround an earnings season. Now, each strategy, you know, works best based on certain circumstances. So there are 5 different ones, and kind of these are kind of the buckets that I look at and try to scan and look at picking stocks out and put them in these different types of buckets. So these are all basically non-directional earnings strategies, okay? These are strategies that would be used just for an earnings release, not going into, you know, pre-earnings or post-earnings, just for an earnings release. So they're non-directional. We don't care if the market goes up or down or the stock does. These are going to be designed specifically for certain things we want to capture. Now here's the first one. This is what we call the short iron condor spread. So basically it's a debit spread, but this one is used and constructed for big price spikes. So there are going to be certain situations like AKAM where the probability suggests that the price is going to be a big potential spike up or down. And this is the way that we can take advantage of that. The next one is what we call the long iron condor spread. This is a very typical one used to take advantage of the volatility crush that we get after the earnings release. Remember, the earnings implied volatility is moving up, and then after the earnings release, all the uncertainty is out, boom, it just fizzles out like popping a balloon. Okay, so it takes advantage of that. The third one is also for volatility crush. This is what we call the iron butterfly, an additional strategy designed to take advantage of that volatility crush. The fourth one is a really cool, different dynamic strategy that I've put together called the double lightning, and it's basically a debit spread as well. So the total risk of this is your debit paid. But this one is really cool because this one takes advantage of both volatility crush plus any price post-trend movement after a trade. So certain stocks you might want to hang into it, you know, after the announcement, and you don't want to get out that week, but maybe you want to get out another, you know, hold it another week or 2 weeks out. So this is a way that we can do this trade with the double lightning or double calendar, basically. And then the fourth or fifth one is what I've designed and put together, which is an earnings pair trade. So this is a long short strategy designed for post earnings trend that's specifically a spread between 2 stocks or stock in an ETF or post earnings trend that gets its catalyst from the earnings, okay? So this is a great way to play a pairs trade from the catalyst of a specific earnings to and what that does to a specific stock versus another stock within its industry or peer, or versus a sector ETF that it's in. All right, so we'll go through all these here today to give you an idea. So the first one is for volatility crush. This is the long iron condor credit spread. And so again, this is going to be a defined risk trade. These are spreads. I don't do anything, and I don't teach anything to my members or clients that are just totally naked. You know, everything I teach are spreads so we can define and have capped risk. So these are defined risks, but it's a non-directional earnings release trade strategy. So I've got another one that I call the new screen, which is really increases the potential trading probability of this trade. So in the course, I'll go over how that works. Now, what this iron condor credit spread will do is it takes advantage of that pre-earnings implied volatility, right? As we go into the earnings, that uncertainty, jacking up the implied volatility. And then we want to take advantage of it by selling time and volatility. That's how we do that, to take advantage of the volatility crush and time decay. And so this will profit from that volatility crush and also time decay. And so the trade duration on these is very short, anywhere from 1 to 3 days, 3 days being about the max, okay, that I'll, you know, set these up for. And these are, you know, what we'll, you know, cover big in the course. But here's an example of one that we've done on JP Morgan. It kind of should give you an idea of how this works. So you can see that JP Morgan, if you just look at the earnings history, here's your implied move history here. It doesn't have huge, big moves. It's a lower volatility stock. So typically, you know, maybe 3.5, you know, 3.5% implied moves are kind of expected normally. Now, then the next thing I'll do, the other step is what did it actually do after the earnings release? Where did it, go out on expiration? So you can see it doesn't have big moves. Like here, the biggest move was about 6.5% down, 7, but no, like 10, 15% moves like AKAM and others. Typically, normal smaller moves of around the implied move, 2 to 3, 4%. So those are things that you want to look at. You don't want to throw this in the bucket of, having a big price move. This is one that has, not big moves. And this is one that we could then maybe take advantage of volatility crush. So then you can see going into this trade, you can just see what the implied volatility history was doing here. Here it was the day before the earnings release. And you can see the implied volatility was 73%. And normal implied volatility for JP Morgan is, low 20s, 25% or so. And then what it did the day after, it was at 207, now it's 204. The day after, it back down to the normal volatility. So all that uncertainty is taken out, so it had that vol crush. So that's what we're looking at. We can take advantage of in this specific one. So here was what it was looking like on the chart. It was trading right here, right around that 207.5. Right here, okay, just kind of churning sideways, waiting for earnings. And then after the earnings, it didn't move much. It just moved down a fraction of a percent right here. So it was really a perfect scenario or setup there, for volatility crush type of trade. So here's the trade setup that we did on this one. So went in and did this, was what we call the iron condor, where we have a call credit spread, short call credit spread, and a short bull put credit spread. Okay, so we're taking advantage of the implied volatility by selling a short call with a spread and a short put. And for this combination, we were able to bring in a total credit of 45 bucks. Okay, so these aren't huge money makers, but they're what we call probability trades. So the credit received was about $45 on this trade setup, and so it was trading at 207. The next day it was going out 205.93. So this was set up with the expected move around 3%. The 1 day, average over 5 cycles about 3.36. So not a big mover. So set this up for volatility collapse and looking for moves of less than 4% on this one. So that's the trade setup that was done to take advantage of these statistics. And so this was just to show you the delta. The delta here was trading, the call delta was really high out of the money. That was 11 delta. So that's more than 1 standard deviation out of the money. And then the 200 strike, the put delta, was set at about 1 standard deviation out. So these again are what we call probability trades, just based on the probability of the trade not moving above those strikes, okay? And so it went out perfect, right where we want it to, right in the middle of our 2 spreads right here. Okay, so here's the credit spread on the call side, the put side, went out there, perfect volatility crush to the downside. So, the spread, we made that money from everything collapsing, and this was up 45 bucks per spread right here, which, on that risk was a 22% return. So that's kind of the typical thing that you can look for, for vol crush, and those are the stocks, things like JP Morgan, some of the banks are the lower implied volatility stocks that you can look at. Now, here's an example of an explosive price spike. So this is then the other type of trade setup is the iron condor, not to be confused with the iron condor credit spread. So this is one that is a really good one if you think there's a chance that the specific stock after the earnings will explode either up or down, but you don't know. This is a way to play it non-directionally. So it's going to give you a defined risk trade, and so debit paid will be your risk, non-directional, and so it takes advantage of the earnings release price spikes either up or down. We don't care, we just want the big move. So set up for explosive moves. Again, short duration, 1 day to 3 days is the most on these types of trades. These are all specific non-directional earnings release type trades. All right, so that's one. And here's going back, here's AKAM. This is one that we did on it based on these statistics that I showed you earlier. So you can see here, just looking at the worksheet, that AKAM has that profile of history of big moves. Here it was down over 14%, up 10, down almost 11, down 8. That was a small one. Going back over, I can go back over more cycles than that, but just 9 cycles to illustrate it was big moves of 10.5%. So some moves were bigger than that. So you can see these were just, back November 2024, August. These are the cycles, the earnings cycles, okay? And so looking at that, that tells me, okay, well, if I'm going to do something on this, I'm not going to sell volatility in time, because this thing could just rip right through your short strike, and you're going to be totally, at risk of your whole, credit paid or debit paid, for example, here. So what you don't want on this is what you're doing here on a trade like JP Morgan, because your potential risk. On this one, if it went through your short strikes, you could lose $205. On AKAM, if you did that, you would be losing something like that or even more. All right, so there's specific things that you do. And so this one was doing the iron condor debit spread. So set this one up as that trade. And so you can see the expected move going into this one was for a move of over 9, close to 9.5% up or down. And the next day, though, this thing closed down down 14%. Actually, I think it closed down more, but the trade setup was for 6% up or down. So you can see here the trade was set up right here going in, where it was trading at 98.15 right in here, okay? And so this was either we were looking for a big spike up, spike down, didn't care, just needed a big move, and this thing just totally, collapsed to the downside. So this is how the trade was set up to take advantage of that probability of that based on the stats. So we did this with the iron condor debit spread. So went out and bought, you can see the 202, 204 call, sold, and then bought the 204, 94, 92 put debit spread. So the trade looks like this on a risk profile basis. Okay, I'll show you that next. So you've got a call debit spread, a put debit spread, and this is set up for either a big, huge spike up or a big spike down. So the potential spread cost, the max risk on this one was 145 bucks. The profit then, if it exploded up or down or up here, was for a profit of 55 bucks on that risk. So a potential for a 38% return. But again, this is a probability trade based on the past performance. Okay, so this one then worked out great. And so this one you can see closed down, was down here, right here, after the earnings release. So this one just got crushed to the downside. So it was trading here at 76.83 as it was going out. So it's max profit. So the debit cost was 145. This went out at a spread cost of $2. So that was your profit of 55 bucks or 38% return on that trade. So those are really cool, and those are done specifically designed for something that has the potential for big moves up or down. Now the next one is kind of a go-to, and this is one that I love to do when we have kind of a low risk reward, but it has the flexibility. What I call the flexibility, we can stay with the trade if we want to for any post earnings trend move. And so this is what I call the double lightning, or it's basically a double calendar. So pretty good design pretty neat design, very dynamic. And again, so low risk trades. These can be super low risk. Again, non-directional, so we can take advantage of the earnings release structure for low defined risk, but we can also have that flexibility to take advantage of any high implied volatility crush, but also gives us the potential to take advantage of any post earnings move. Okay, so this is that flexibility allows a trade to profit if we want to stay with it after the earnings release. So I'll show you how this works here in a minute. And the trade duration on these are a little bit longer. They can be we can just be in for 1 day, or we could be in for a week, or we could even structure, sometimes we structured it for 2 weeks, but typically would be maybe 1 day to 1 week out. Okay, these will always have positive data, so no time decay as well, so we can kind of hang with the trade, for that trade movement. All right, so this, what sets this strategy apart from the others that sell volatility as well is that we can adjust this into a directional trade after the earnings release. So this can give us that benefit of providing the big potential for big profits from post-earnings directional move. So I started using this one back in 2020, and it really shot up our performance of the trading, the earnings trades. Okay, so we've been running, again, these are very, very selective trades. I don't just send out tons of these, but these are very selective trades. But since starting this service back in June of 2019, we've had 140 trades closed out, 101 trades are winners, 17 break even, 22 losers. So 84% winning rate, again, unaudited. And again, just to point out, these are very, very selective. So look at the trades like the AKAM, those stats and things like that to select the trade. Now here's an example on one that we had set up on STZ, so non-directional, low risk, volatility kind of collapse. So here's going looking at the earnings again, the statistics, just a kind of quick summary of what I'm looking at. You can see the implied move here, history here. Not a huge mover, kind of 3.5%, 4% moves, not big. That's what we're looking for in this kind of strategy. And then what did it actually do, the day after on its expiration, this one a day later? You can see not big moves, 3% was about the biggest, 2%, 3%, that kind of move. So not a big mover. So this is a kind of one that we can look at for this kind of potential setup. All right. So set this trade up then it was trading at 242.33, expiration the next day. And so the next day, then it was trading up at 247.5. So we set this trade up. The expected move was for 3.51 up or down. And we set the trade for a movement either up or down of 3%. All right. So in the course, though, I'll go through more detail, the reasoning, the checklist, and all these things. Plus, in the course, we're going to go through how to scan and set up your list of these trades, and then put the watch list together, get ready for the trade, set up and structure the trade. But you can see this one had that implied volatility. This is what we wanted. It worked out perfect. So you can see the implied volatility moving up there on STZ. What happened after the earnings? Crush. Okay, so this one was taking advantage of that, designed specifically for that and for low risk to do that. So you can see here, it was trading at 242. This was before the open. This was going to be before the open on the 5th. So this was one that we set up on the 4th before the close. It was trading at 242. And so you can see here right there, and it had about 86% implied volatility. So it had a pretty good implied volatility based on the normal volatility of around 25%. So the next day, though, collapsed back down to the normal volatility, and that's perfect for what we did on this trade for the setup. So here's what makes it really cool. We had this trade expected to move 3.51%. Trade where you set the structured up, all we wanted it to move was either 3% up or 3% down. Now, and look at the break even, really wide break even. It would have to go 4% down or 5% down or 4% up for your break even points. They were way, out. So really safe trade. And so what this trade setup then was doing was we were targeting either a move of 3% up or 3% down. So you can see that curve there. It looks like kind of a Batman, but that's what we're looking for. And then we're playing that implied volatility crush. So this trade was then, we'll go through and I'll show you all the details in the course of how this is done. But the trade was set up for a total cost of let's see here, we set this trade up for $150, okay? That was the spread cost, okay? That was the debit cost. Now the spread blew out, here at expiration. It was trading up here at 247.53. So it was trading up around that 3% area that we were looking for targeting. So the spread blew out to 330 and less our costs. So this was up $180 or 120% return in a one-day period. And the other thing that we can do with this type of trade, though, the flexibility of it is if we want to stay with the trade for more post-earnings upside move in this direction to this one to the upside, we could close out the put side and just stay with the call side. What we'll typically do there is convert it to, either a call, debit spread, or condor or butterfly. So we'll talk about that in the course and how that's done as well. But that's a very good example of STZ on that one. And here's just another really good one that we did. This was on CL. So this is to show you how cheap and low risk these things can be. So here was on the, this one here was super low risk. So you can see the implied volatility move here was, around 3%. So not big. And you can see the day after earnings, very, very small moves, about 2% up or down. All right. So this was a good one to put in that bucket as far as potential trade for that double lightning. So we set this trade up. It was trading at 80.96, and then it was set up on the 25th, and then the expected move 2.83% up or down. We set the trade up for a move of 2.5% up or down. So trading right here, and this did move to the upside versus the downside, but we didn't really care. We had it set up for either way, had that volatility crush. And so here was the trade setup going into this trade. You can see this was Colgate, and you can see the 83 strike that we sold short had an implied volatility of 46. This is what we call skew. And so it had a 46 implied volatility, actually a little over. And this is what big thing that we're taking advantage of is this positive skew that we have in these types of trades. And then you can see the next day that 83 short strike had collapsed down to 14%. All right. So these are things that you'll learn in the course, how this implied volatility skew works to take advantage of that. All right, so that's what we were looking for to set up. And this was the thing that makes this really a cool trade, because some of these things can be so cheap. So the expected move on this was 2.83%. We set it up for either a move 2.5% up or down, had wide break-even points, 4% up, 4.5% down. So very hard to lose money on these, or to lose much money. And look at the risk on this trade. So this trade was set up for total risk of 17 bucks, okay? And then the trade blew out to 53 bucks on that spread. So that was a 36% or $36 per spread. Or you look at the risk of the trade of 17, that was a 211% return on this trade. Plus, if we wanted to, we could have stayed with the trade for a post-earnings move, trend trade either up or down, based on what we're looking at there. So those are the kind of the category and the different ones depending on what the market's telling us. Now the next one is kind of the fifth one that I showed you earlier. This is the earnings pairs trade strategy, and this is a market neutral trading strategy that I put together and designed just for trading a post earnings trend trade. And so a lot of time pairs trades are great because the catalyst that makes the pairs work is the earnings. Okay. So they can make a big, a trend in a certain stock either up or down for a considerable period of time. And then to make it market neutral, you just trade something against it the other side as a pair against it to neutralize the overnight directional risk. Okay, so that makes it market neutral, but we're just playing the spread. So pairs trading or spread trading, again, just kind of to, summarize what it is, it's a market neutral strategy that can be used to trade a post-earnings trend move on a stock after its earnings release. So by trading pairs or spreads, this will help to mitigate any overall market risk. So any market risk, you don't have to overnight, you don't have to worry about that. We're just playing the spread. So by simultaneously taking opposite positions on a related security, this allows you to reduce your exposure to any big, huge, broad market movements. So, you can just think with the tariff, you have tariff one day, the market spikes up, spikes down. This will neutralize that. All you're playing is the spread, the correlation between a certain stock and something that's correlated to. So it's a really great way to trade, and that's why hedge funds are called hedge funds, because they're trading pairs. So in other words, a pairs trade is going to be equally likely to profit whether the market you trade goes up, down, or sideways. It doesn't matter again. And in the course, I'll teach you how to do these types of trades using synthetic options. So instead of having to buy or sell the short shares, we're going to do it synthetically. So you'll learn how to do that in the course, which is a really cool thing to do. So the other thing with a pairs trade is it can make money 5 different ways. So I'll show you a couple examples here in a minute, but let's say, you have, I'll show you the next example will be QQQ and Apple. So let's say, in the next example, I'm going to show you Apple has earnings where it doesn't really do much, and QQQ starts to outperform Apple. So this would be an example of you being long QQQ and short Apple. So if QQQ goes up faster than Apple goes up, you make money, okay? So the QQQ is going up faster, or it could be the other way around, but the spread after the earnings really started to have a catalyst to push Apple down. So we paired it with QQQ. Or QQQ could rise and Apple could go sideways. So QQQ could gradually go up, Apple could go sideways, and that spread's widening, you're making money because you're long QQQ, short Apple. And I'm in the course, I'll teach you how to do this one with synthetic options. So we can be long QQQ synthetically, where we're not long the shares, we're long at a fraction of the cost, and we can short Apple synthetically. Or you could have it where QQQ goes sideways like this, but Apple goes down. You can see that spread widening, right? So that's what we're playing. Or we could have QQQ go down, but Apple go down more and faster. Or we could have the perfect scenario is where QQQ goes up, Apple goes down. That spread widens, we're making big money. So these pairs trades are really cool, and the catalyst will be earnings, okay? So these can be then structured with the synthetic options, which you'll learn how to do, next week in the course. So this will then lower your trading costs and the end of, the hassle of borrowing shares. You won't have to do that. And the cost versus your underlying, shares is just a fraction of the cost. It's a really great way to structure longer term trades. So here's an example just to give you an idea of what these spread trades can look like. Okay, and there are a number of different ways we do it, but this just kind of give you an overview. So here it was Apple on this, we'll call it earnings one. So it was trading right here, okay? So Apple is trading here. Now, Apple, was trading down here at 165, and it did start trending up, all right? So it did start trending up. The earnings were good, it started trending up. Now, here's the second trade, though. Here's Apple on the 3rd of August, not good earnings, and look what happened to Apple. It started trading down, okay? So we're going to look at this as a spread, though, and we're going to have this trade correlated with QQQ that has a pretty decent correlation to Apple. And in the course, I'll teach you how to, to define and look up those correlations. All right, so here's the spread that we did was then long QQQ and short Apple, okay? So even with Apple going up, QQQ was going up faster. So here was that spread. The spread on the 4th after the earnings was at $152. So the just pure one-to-one spread was QQQ was $152 higher in value than Apple. And then even with Apple going up, this is just the spread. QQQ then was going up more than Apple, okay, on the spread. This is just that line is the spread value increasing QQQ over Apple. So it went from that 152, and then on the 18th of July, now that spread was at 191 right here. So right there. So that move from 152 to 191, this was a $39 per share. Okay, now we're going to do this type of trade, and of course I'll teach you how to do this with the options. So if you did one option contract, this spread would be up, one option contract equivalent to 100 shares, right? So this spread then was up $3,900, okay, on a one-to-one. All right, so that's how these things work. So there it is. Now the next one was Apple was crushed to the downside. Now at that point in time, you had QQQ was trading at $183 over Apple right here. Okay, Apple had those horrible earnings, okay, and went down, but QQQ was just gradually moving up, and you can see it moved up here to 201. All right, so then that spread went in value from 183, right here with Apple going down, QQQ just kind of gradually going up. Now that spread had moved out to 201. So this was a gain of $18 per share. Or if you did it with options, one option contract, that would be a movement of $1,800. And it didn't matter if things were going up or down, overnight, whatever. This was just playing that spread value difference, and that's how you play the spread. So that's what we'll, go over the course, how you structure these with the synthetics, how you pick the correlation, things like that. A really cool way to trade. Here's just one more example. This was like Nike. So on the earnings one, it was trading, Nike was trading right here at 113, and then you can see the earnings came out, it just started really falling apart, right? And then here's another one that we'll go through. Here's earnings two. Nike was trading right here at 89. Earnings came out, it had a pop to the upside. So here's the spread. So on this one, this could have been spread. This was spread with SPY. There are other things that it could be spread with, but this was the one that was chosen, the ETF. So you can see here Nike on the 29th of June, that spread that was Nike was $72 over SPY. And then you can see that spread went down from the 26th now. The spread was down, was 14, minus 14. So you can see that spread then changed from 72 plus now is down minus 14, so 86. So this would be like if you're shorting Nike and long the SPY. You can do it the other way around, but this is showing that spread relationship, Nike being short. All right, so Nike was short at 72 over, and then it was 14 under. So it was right here. Let me kind of right here. So it was right there after the earnings release. And then you can see the spread just continued to collapse down and got us low down here as 14 under right here. All right. So that spread went from 72 over. Nike was 72 over. Now it went to 14 under. And so, that's an $86 per share move or increase if you'd shorted that spread. And that's 8,600 per 100. Here's one more. Here was Nike on the 28th right here after the earnings. And this time it went up. So Nike was trading at 2.5 under, and Nike then went up from 2.5 under right there, that blue, to had a movement of 84 of 81.5 over right there. Okay, moved up in that range there. So that's a move of 2.5 under, 81 over, 84. Okay. So that's how, we'll go over in the course how these work, but the big catalyst for making the spreads work and then picking the correlation is the earnings after the earnings release. So a really cool way to set trades up that are non-directional or directional neutral for any kind of systemic risk overnight, whatever happens. You're just playing the relative strength between two correlated, somewhat correlated instruments. All right, so that's kind of, what I wanted to cover here, just to give you an idea of the different ways that we can do trades and take advantage of things. Now, will every trade be a winner? No, I wish they could be, but I guess if everything you did was a winner, you get kind of bored with what you're doing. But, what works is to use, again, kind of a systematic approach to find the highest probability trade setup. So that's the homework. That's the thing that you have to put in to do it. And so, let's talk a little bit more about how you can start, doing this and, get on top of it this new earnings season, which kicks off here this next week really with the bank. So we'll be doing this course again. This will be next Saturday, the 19th of July. We'll start out, everything's live, but everything's recorded. Then we'll break it down in modules. So 11 to 2 or however long we need, and then we'll finish up Monday from 4 p.m. Eastern to 5, and then we'll follow up with a designated Q&A, dedicated to the earnings. Okay, so if you use that special promo code earn15 and use that link there, powercycletrading.com/special, put in that earn15 small cap, then you'll get that discount EARN15. Make sure you put that in. Make sure it's small cap though. Okay, put that in, and then you're going to get everything here this total package value of over 2,600 bucks. And so next week though, it'll be not 197, but if you set it up today, it'll be 167. So this was a really nice testimonial that I got from one of our members. And this was, said, Larry is a great teacher. I've had a few, and Larry by far is the best. I also enjoyed his earnings course. I made 3 trades in the past couple of weeks. Larry would be happy. I followed his teaching and traded Broadcom, AVGO, for over 1,000% winner. That was pretty big. Not sure exactly what he was doing, but that was a good one. I must say I'm not sure if things are finally starting to click for me or if it's Larry's awesome teaching, but I'm trading better than I ever have in the past 3 years, closer to 4 now. It's probably a combo anyways. I'm not tooting my own horn here. I just wanted to leave a comment that is positive for Larry. I've been through a lot of different programs, seminars, trading groups. What are you're doing here is by far the best, in my opinion. And that was Mark. So if you're here, thank you, Mark, very much for that nice testimonial there. So I want to put that in there. And then everything you're going to get, if you do 2 different packages, like I showed you a little earlier, course package 1 has a total value of the course is $1,600 for hour. But today you're going to get, instead of the 197, which when I go out to my list will be 197. Today, if you use that promo code EARN15, it's 167. And then you're going to get, for additional bonuses in the course, you're going to get my 7 hours earnings option course with all the different strategies here. You can start right away, and this is on demand. You'll get that. And then you're going to get a 30-day trial membership to my trading club. You can start this whenever you want. You can wait till after the club or after our earnings course is done. So that's a value of 97. Now, if you stay on, it's 97 a month, or we have other different packages that you can use as well, but that's what it is month to month. And then you're going to also get my Start Trading Options Today, which is another kind of medium term, intermediate kind of term option trading strategy or course, debit spreads, things like that, how options work. So that's 197. We'll do the live follow-up dedicated Q&A. And another course that I did, it was how to use the Greeks. So this is just basically a short course on using the Greeks, delta, gamma, theta. And then you'll get my trading list that will be using this earnings season. So 3 different trading lists, which I'll talk about here in a bit. So you'll get that. So everything here, over $2,600, use that promo code EARN15. It's 167 today. So use that powercycletrading.com/special, and you'll get that bonus discount there of 15% off, or 167. Now, if you want the my Alert Trading Club package added to this is course package 2. Now, remember, you're going to get everything in course package 1, but you'll get my alert service, 5 different trade alerts that I may send out for the next 4 months on that, plus 4 months membership to the trading club. So you'll get all that, and you can start and stop whenever you want. So you can, after you can wait till after the course to start it. If you go on vacation, you can automatically stop it, start it back when you want, so you're not losing your time. So you'll get that and everything in package 1. And then what this will give you is my various different alerts. So it could be based on what the market's doing. It could be maybe a butterfly or a long condor. It could be a calendar or calendar diagonal. It could be a butterfly for a pinning trade, into option expiration, or a calendar pinning trade. Or it could be some kind of breakout reversal or credit spread trade. So it just depends on what the market's given us, and that's what kind of the trade I'll send out. Or it could be a very selective earnings trade setup, since we're starting to enter into earnings season. So there are 5 different types of trades that are sent out, and then I'll give you those different trades when they send out. We use a service called Telegram, so it sends it out like within seconds of when I put the trade together. Click the button, the send button, boom, it's right there in your text message, or we can send it to your email. And so that's what you'll get there. So you'll get the different 5 different alerts, anywhere from 8 to 12 stocks or ETFs then per month. And those are the different trades that could be sent out. It could be we do a lot of butterfly and long condors, calendar diagonals, option pinning trades, reversal breakout trades, credit spreads, debit spreads, or selective earnings trades. So when I do send those out, a lot of members just do their own thing, but I'll always send out a trading guide. So there'll be a specific type of option trade with all the different parameters of the trade, that, what option series to use, the stop loss levels, targets, etc. So then I'll do a video review of those trades after the close. The trades are listed in archive, and then you're, having with the trading club for the next 4 months, you'll have access to the live Q&As every week, live and recorded, video newsletter that I do after the close every day, and access to our virtual trading room, which is open every day during the week, and you'll have access to that. Plus, anything on my course or website, you'll get a 60% discount as a member. So I've got a lot of different other option courses, trading courses, and a lot of trading software. So that's kind of a summary of what you get there, plus everything in course package 1. So a great deal. And again, click on that link and go down to course package 2 right here, and click on that course package 2 right here, and put in that earn. Again, you can get 2 pay if you want, and if you want my indicators, you can add those to the cart, and then put in that earn 15, hit apply, and you'll get it for 507, or you can do the 2 pay and get the 15% off of that. So put those in, and then we're going to go through. I'll show you some examples of some of the alerts we've done here recently, and then all the different additional stuff you're going to get. And then any questions, please feel free. Let me. I think I missed a couple of questions here. Hold on, my GoToWebinar didn't scroll. Yeah, Samush, hold on. Oh gosh. Let's see here. I will have to get that to you. Okay. I should have it, but it when my computer went down, I lost it. So I'll make note of that. All right. So just the Elite Open and Close Trade Alert Service summary here. These again are unaudited, and we'll go through a lot of these different trades to kind of show you, what they look like, how they work. But since starting the service and adding to now we have 5 alerts that go with the service. But the first started back in May of 2018 through Friday. We've had 895 trades closed out, 644 winners, 61 break even, 190 losers. So we're running around a 79. I try to get high winning rate percentage trades with low risk. That's kind of my goal. And so we've been kind of consistently staying around 78, 80%, that range of trades, winning trades, Okay, some are small winners, some are break even, some are big winners. So just, a combination now. And then with the alert service for the earnings, these are, again, very, very selective. I only really try to pick just ones that I think are going to really be selective and work. So we've had 140 closed out since starting this back in 2019, 101 winners, 17 break even, 22 losers. So these are a high winning percentage, because a lot of these have been these double calendars, which give us a high rate of winning, and low kind of, a lot of times if they're not winners, they're break even. So we can really keep our risk super low on these types of trades. So these are kind of a summary there. And again, here it is, 19th of July, starts at 11 a.m. and put that paracycletrading.com/special in there. There it is right there. And you'll get, all the good stuff. Check out your list here, see if you've had it before. If you, don't see it on there, then you never have taken the course. And again, these bonuses, I know that maybe you already have them, but these are going to be, part of the bonuses for today. So these are just included free of charge as an additional bonus. The course alone is worth a lot more than just your bonuses, but I wanted everybody to have a great deal. So that's what you're going to get. And everything today, if you use that discount code EARN15, you'll get 15% off, EARN15. All right. Now the course, here's what we're going to cover, kind of an outline of the course. And we'll start out with the 5 steps to perfect your trade setup. So we're going to, the big thing is the analysis. Okay. So this is, how to select the trades, the analysis and the tools used for that. So it's a very selective screening process that I go through to use to identify these kind of most probable winner type trades. So we'll go through the analysis in part one, the resource I use for that, for that statistical analysis, how it's used and how you can then put your own list together. Now I'm going to start you out with 3 lists that I put together for scanning, but then in this course, I'm going to teach you how you can do it yourself. And so then we go through the option pricing, how that works to, make these weekly option strategies work, the components of, volatility and time, how that works to, impact the price. And then I'll go through my, secret resource for these statistics for the history of all these different stocks, how to quickly scan and capitalize on this earnings data. We'll go through the scans and how to analyze the data. Very important for any of your, earnings pre-moves or post-earnings move, or, the non-directional moves. And then my formula to create an efficient watch list. You want to put together a watch list and then focus on that. We'll put that together, show you how I do it, and so how you can kind of put that together for your trading. And then the live course part is part 1 and 2. This is the live 4-hour plus course. So in the live course, we're going to cover these specific strategies. The iron condor for big price spikes. This is one we're going to cover for the volatility collapse. The iron condor debit spread for price spikes. These are the 3 that we're going to cover in detail. And then double calendar, and then also the pairs trade. Okay, so these are the strategies in the course that we'll cover live, and these will all be recorded. So this was from one of my members saying absolute best earnings strategy I've found, as well as an overall excellent option strategy, period. You'll learn in depth how then and why to use this dynamic strategy based on 10-step guide. Details cover the earnings double calendar, include how to choose the optimal strike price. This is what we'll cover in the course. How then to construct the initial setup through the option expiration with ease and perfection, and then how to adjust if we need to the double calendar into a free trade with 0 risk. So these are what we're kind of focus on doing, and so this will be part of it to show you how we could go about what we do, these adjustments after we get the trade on. So they're really cool structure to start with, and then we can do so much off the trade. That's why I call it a flexibility trade. And then part 1 and 2, we're going to cover then the earnings pairs trade strategy, which is a really interesting strategy that is market neutral, pairing a post-earnings trend move from a stock after its earnings release, the catalyst being the earnings to make that spread work either up or down for a specific stock, like we saw QQQ relative to Apple, or Apple relative to QQQ, or Nike to SPY, things like that. So we'll go through how you can find the correlations to put the stocks together, how to construct these things using synthetic long short options, so you're not actually long the shares or short the shares. So really just fantastic way to trade. You may decide this is all you want to do for your trading in the future. So how to identify, select the best earnings stock pairs trade, how that's done, how to statistically measure the pairs trade correlation to identify the best pair to trade it with, resources for measuring the correlations, what I do there, and then when and how to set up the trade using synthetic long short options and how to execute that. So that is a big, that alone is a course I'll do later in the year, just for pairs trade, but you're going to get that for this earnings course here, this next weekend. And then part 3 is just a recorded part. So this is just even more in-depth stuff. And this one kind of what I don't really go over in the live course, the iron butterfly, but in the on-demand part, it goes over all these strategies additionally as well, but also covers the iron butterfly. But the ones in the course that I really think are important will be the long iron condor and the short iron condor, and that double calendar and the pairs trade. All right, so but this is just an additional course that you're going to get, so you're really covered. And so it goes through all the different calculations of how to construct your earnings trade, that earnings implied move calculation, just a really great amount of stuff. And then you're also going to get a trading library, so you can go back and look at old trades, past trades, and that's how you can really learn about successful trades, just go dissect the winning trades or even your losing trades to see what you did right or see what you did wrong. And that's a great way you can learn. So you're going to get a really great earnings library trades of over 40 trades. So you can go back, these are earnings trades. You can go back and look at how they work. Things like Apple, Google, Baidu, just an extensive list there to go back through. And then this was a really nice summary and testimony from one of my members, Mary. She said the course is explained in clear and simple terms how to trade options on stocks that were coming into an earnings report. Larry showed the specific sources of information used to determine which of the strategies is most appropriate for the stock that is reporting based on its historical data. He gave then specific guidelines as to use for each and how to exit the strategy. Larry goes over the material in great detail and shows examples of strategies from past performance. One thing that impresses me with each course I've taken is his willingness to repeat an explanation if someone asks for clarification. He schedules classes for a certain time frame, and because he wants to ensure that each participant has understood the information, he most often goes over his planned time because he has stopped to answer questions thoroughly. So that's a really good summary of how, how the course typically goes, and what Mary thought about as well. So here's just a kind of quick summary of your enrollment bonuses. So first off, you're going to get right away my comprehensive 7-hour earnings course. This is on demand, so this one you can start right away before we even start next Friday. And so you'll have this, and this is going to go through these specific strategies: the double calendar, iron butterfly, long condor, short iron condor, the things that you need to know there, in-depth explanation of each strategy, how, why, and when they're used with trade examples. So you're going to get this, right away to start with. And then special price bonus 2 is you're going to get that 30-day trial membership. And again, you can start this after the course or later if you want, but this will give you access to my virtual trading room for the next 30 days. Now, if you stay on, it'll be $97 a month, or we have other packages. And so the trade room's open from 9:30 to 10:30 Eastern every day, Monday through Friday. And then, come in, ask any trades you have on, or see what we're trading, doing there. Daily market video newsletter every day after the close. I send that out to my members. Members trading video archive of different videos, past videos, educational stuff like that. Then we do a live weekly Q&A every week that's live and recorded, access to that. And then a trader's educational vault with good educational material. And then again, you're going to get for the next 30 days, your membership code will give you 6% off discounts on any courses or software on my website. So if you go to my website real quick here, you'll get, as a member, anything on my site, you'll get it 6% off. So any of my trading software, if you want any of my trading indicators or scanners, you can get any of that. So for a discount of 6% off. So you go down here and you whatever it is, you'll automatically, when you put your promo code in, you'll get the 60% off of the price. Okay, so for my scanner, for example, it's $397. You put that in, add it to your cart, and then you're going to get your promo code. You put that in for that members discount. It discounts this off 60%. That's software. And then also any of my trading courses, the same thing. I've got a lot of different trading courses on trading, mostly dedicated on the option side. So synthetic option course, pairs trading, just a lot of stuff there you can have access to, all right, for that discount. And this is one thing I always like to highlight. This is Jay, one of my longtime members. He says, reading books is fine, but seeing the actual option trade setup makes a huge difference. So that's what you're going to get in the trading room. Come in, ask questions, whatever. If you don't understand a trade or something that you currently have on, you're having a problem with, come on in there, trying to help you fix the trade if you're needing that help. Hey, thank you, William. If I may share that, here's a nice comment from William here. Appreciate that very much. Click that in there. William says here, if you can't see that, he says, thank you, Larry, for your expertise. Your expertise shines. Appreciate that. Now you're going to get also then bonus 3 is start trading options today. This kind of intermediate course takes you through what are the benefits of options versus stocks, must know option basics, how they work, mastering puts and calls, how option expiration works, and then 3 different strategies are covered in this course: covered call, and also the covered call with the protective put or collar and the vertical debit spread. Those are covered in the course, and so you'll get that, a really nice course there. And then we'll do a dedicated support Q&A on Tuesday for the earnings course. Plus, remember, you're going to get 30-day trial membership. So that's also additional support. Or if you do the package 2, you'll get 4 months of the trading room. So that's great support for you there. And here, Barbara, you have powercycletrading.com/special. Put that link in. And then earn 15. I'll put it in one more time here. Put that in. Okay, and then earn 15. Small cap, and that'll give you that discount. Okay, so then you're going to get bonus 5, how the pros use the Greek. So this is just a short course video and a PowerPoint course with on the Greeks of delta, gamma, theta, how those are worked, how option pricing works, what the market maker secret is, standard deviation, how that works, option delta, trade probability. So just more option educational stuff for you to kind of put in your library there. And then you're going to get my current, I'll send this out to you, my earnings stock watch list. So these are going to be 3 specific earnings type lists that I put together. And in the course, you're going to learn how to do the scan for yourself. So these are based on 3 different screens I do. One is for, a screen of 5% or less, or 7% or less, or a screen of, 6% or greater. So we'll go through the course how to do these screens and how they're used. So just for example, list 1, this was for the last go around, was everything we scanned, and it set up a screen for everything that had a max move of 7%. So you can see things like JP Morgan, Goldman Sachs, GEV, Procter & Gamble, and then it shows you the average volume, recent closes, whatever, but here it shows you the earnings days coming up, before or after. And then these are the scan. The list of 2 was everything that had a max move of 5%. So you can see things like Abbott, Visa, and then when the next earnings are, after the close or before. And then the other earnings list you'll get is a watch list of moves of greater than 6% up or down. So you can see here like Spotify, Etsy, VST, Z, things like that when the earnings are coming up. So this will be the current one that I'll send out to you, but then you'll go and learn how to do those yourself. Now here's some trade setups, for the trading room alert service, and here's a little bit of nice feedback. This was from Dan. He said, "You're very diligent, totally thorough with your analysis. That is the foundation of the success of the alerts. I paid for my subscription with the first 4 trades I took with you when I was just learning how to trade options. Please feel free to share this with your other participants, Dan." And this was, from Scott. He said, "It'll be the best investment that you'll ever make. Go with the elite package, great group of traders." And appreciate that very much. So that'll be package 2, which you can get with your discount of 507. And so when I send out a trade, a lot of the members just do their own thing. So I'll send out a trade. It'll say like go long. Last week on Friday, we did a long trade on GLD. So some members may have just gone long the shares or gone long the calls, but I'll always give you a suggested option trade. All right, and that within that trade, I'll give you everything you need: the entry levels, profit targets based on my price target mapping, what option series to use, stop loss levels and guidelines, and then these trades, I follow the trades all the way from inception to the end of the trade, given any updates or any adjustments that are needed for maybe if we need to adjust the trade. These are all listed in archives, so that's what you're going to get there, kind of a summary of what you get with the trade. And then, when I do it after the day is over, then I'll do a trade setup video review of the trade, why I specifically, did the trade, what was the reasoning behind it, what I'm looking for there, so you kind of understand it better. And that's also with the video newsletter every day after the close. And then we do live and recorded weekly Q&As you'll have access to for the next 4 months. And then the big benefit here is that you'll have access to my virtual trading room for the next 4 months from 9:30 to 10:30 Eastern every day. So come in, see what we're doing, see what trades we're looking at, or see if you need help on a trade, come in and ask. And I'm there to help on any trade setups you have. Plus you get the 60% discount on anything on my website, courses and software for the next 4 months in that Trader's Educational Vault. So a lot of great benefits there that you're going to get, with that. Now here's some, earning trade alerts, the examples. Here was KG. KG was just the earnings animal. He said he made a lot more. This is back when that was $1,200. I lowered my price, but he covered his costs pretty fast. So here again are the earnings trades. We've had 140 closed out, 101 winners, 17 break even, 22 losers, 84% win rate. Now here's the one that we did on AKAM. So these are when I send out the alert using Telegram. They're very, very specific as far as what I'm telling you. So if you look through these earnings trades, I give you a lot of detail. So these are sent out within seconds of when I send it out. So here's the trade that I sent out. This was on AKAM. So it said earnings iron condor debit spread, trade for more advanced option trader, earnings after the close, 2/20/25, expected move, 11% up or down, based on that option series. Then I give you some statistics over the last 9 earnings series, 8.8%, up or down, biggest move, smallest move. So just giving you a lot of details there so you understand the trade. Look to set up the trade 30 to 45 minutes before the close. Then I go through, how to set up. Current example, it's traded at 98.15, and this was doing an iron condor debit spread, constructed for a move of 6% or greater based on Friday's close. Okay, so this was the one on we did on AKAM, and here was Friday's close, and it said, trade iron condor debit spread, look to take profit on this move lower today. Max profit is at close below 92. We'll follow up. So that's kind of what is sent out, so you get an idea of what it looks like. Telegram. And here was that trade I showed you earlier, so we'll kind of skip forward, but this was AKAM, and that was the earnings alert trade sent out there. All right, so that was a really good one that was very selective. Now here's another, we do a lot, probably of all the trades we do, mostly calendar diagonals and butterflies and condors. So here's just the breakdown of this segment of the alerts that are sent out. So since starting this part of the service back in June of 2019 through Friday, we've had 345 trades closed out, 248 winners, 21 break even, 76 losers. So run about a 78% win rate. This is, we hover at about 78, 79, 80%. Again, unaudited, so there's kind of the win-loss ratio there. And so here's a couple that we've just done. This is one that we just completed. This was a really cool one. This was on KRE, which is the regional bank ETF. And so this was a trade that we were in for, for these types of trades fairly long. And so I'll briefly go through it because this had a lot of different adjustments that we did to it, which I send out. So these are just a few of the major adjustments, but we did quite a few. But this trade was initially set up on the 27th of June, and the KRE ETF was traded at 59.88. So it says here, it'll say new KRE long, trading at 59.88, daily cycle low, retracement reversal. I'll give you what I'm looking at, as far as the technicals and stuff. So it was reversing off the 21 exponential, breaking above its 200-day, things like that. It had on our momentum indicators, positive momentum. It had a momentum upside cross that we use an indicator for. So then I give you the target one. Here was 61. This trade was, we did a lot of adjustments. So know your risk. And then here was the initial trade setup. And we'll go through this in a minute, but it was to buy the calendar. All right, so this was super low risk trade, but it turned into a huge winner. So this was buying the 11 July, selling the 30 June, 61 call. That's a calendar, okay? So we did this initially for $58. That was the risk, okay? Now, then on the 1st of July, we did our first adjustment. So I won't go through the details, but it ended up adjusting this to a call debit spread. So now we're long the 61.63 call debit spread. We went out and I won't go through the details, it'd take too long, but anyway, that's what we adjusted to. And then the same day, we did another adjustment to reduce our trade spread and risk even more, adjusting this to a butterfly, the 61.63.65 butterfly, okay? So that was another adjustment. And then on the 3rd, we did another adjustment, and now we adjusted, it was trading at 63.35. So this thing went from 59.88, and now we're at 63.35. And our last adjustment, we adjusted this to a really low risk trade into a long call condor. All right, so now we had this trade into condor. We were long the 62.64 call debit spread and short against the 65.67. So we had this call condor that we ended up trading, and this thing ended up huge return, over 1,800% return, which sounds crazy, but the way we structured, look, the first setup, we were in at 58. We reduced this total risk down, expanded the profit zone. We reduced this trade from 58 bucks to $8 of risk and had this huge profit zone. That's why we had such a huge return, because we had such low capital at risk. Okay, so then on the 10th, that was Thursday, this thing was trading now at 63.93. So it went from 59.88. Now on the 10th, Thursday, it was 63.93. I said, send out alert, looking great for a move into our max profit zone tomorrow, which would be around $192. That'd be a 2,400% return on that call condor. Make sure to lock in some profit. Currently up at that point, yesterday was up 151, 153. It was up over 1,800% return. All right, so that's just the one that we did very recently and took off on Thursday, Friday, and we had a couple other stops along the line, but here's where initially the initial trade setup, so you can see what it looked like. So it's trading right here, 59.88. We were breaking through that 200-day moving average. Our momentum indicators were positive. Everything we looked for looks good. We did our first adjustment here, did the other adjustment here, profit take here. So ended up, at that Thursday, it was trading at 63.95, up $153 per spread at that point, over a 1,900% return on Thursday. So we didn't get it perfect, but we got pretty close and a super low risk. So this trade started out with that calendar, and with the adjustments we did, we ended up adjusting the risk down to $8 on the spread. So we then ended up with the 62.64. Okay, it looks like this, and then the short side was 65.63, and that spread, then you can see, was $2 wide on both the call side and the put side, and we had this profit zone in here, which would be the max profit. But potential max profit with the spread width of 200 less our cost of 8 that we reduced the risk to, was, if it went out right there, it would have been 192, or 2,400% return. But we had different profit stops along the way, but on Thursday that was kind of the max. We had, this was up to $153, and that spread blew from $8 to 161, so up $153 on that risk of 8. So that was a 1,900% return. Okay, so those are the kind of things that you can expect from the trade alert service. Okay, so it's a great service for small accounts or big accounts. Okay, I try to keep these trades very low risk. Here's another one that we did not too long ago. This was on Dell. So we said, now I won't go into the great detail, but this was on Dell. So this was on the 18th. Dell was trading at 117. We did an adjustment on the 20th. It was trading at 118.77, and then we had profit take. On the 25th, it was up 207, or 828% return. So here it was on the original inception of the trade. It says new Dell long, trader 117, daily cycle low retracement reversal of 21 at 200, and then it goes down here. It says know your risk. Here's the trade. We did this as a calendar diagonal with Dell. So this was buying the 27 June, selling the 20 June, 160, 120. Now, when you become a member, I also give you what I call my cheat sheet. So it'll explain, the trade lingo. Okay, so you might get confused, with the trade lingo and sent out, but I'll give you a cheat sheet that explains it exactly, how to understand any of the trades that I send out. Okay, and so then the 20th, we had an adjustment right here and turned this into a condor. And then on the 25th, the trade, we had the condor was then currently up about $207 per spread on our risk 828. So 828% return on that. So Dell here had again, we were looking at the breakout to the upside. It had that positive momentum, things I look at, for all the trade setups, specific things I look for. And then we had an adjustment here, profit there. And so this went out up, $207 per spread, 828% return, because we adjusted the risk down so low by adjusting the trade into another long condor. So here's the trade. When we initially did the trade, this was what we call a calendar diagonal. And so this was initially set up for $310 of risk, and then it blew to 362, and our cost was that. So we had an initial trade profit of 52, so 16% return. But what we did was an adjustment to adjust this trade into a spread we call the long condor, which you'll learn all about in the trade room and things like that, and also at the course. Okay, so then we adjusted this to this long condor. So now we had this trade, the 116, 119, and then shorted against that spread, the 124, 127. So we had this kind of risk profile structure, and we reduced the trade down from the 300 down to 25 bucks on these kind of adjustments. So remember the first trade we had on as a calendar, and then we adjusted this up and really took a big profit on a move to the upside, and then set this credit spread out here, big credit we brought in, reducing our total risk or debit cost to 25 bucks, spread with 300 less 25, potential to make 275, over 1,000% return there. So these are the kind of trades that we're trying to structure and achieve. And this is kind of where it was going out here, was right there, on the 20, this was on the 25th, this was trading right here. So took that profit, 232 less 25, up 207 bucks right here on that risk of 25. So 828% return. So that was on Dale. And, so I'm giving you these, guidelines all along during the trade. So you're not having to watch your screen every second of the day. I'm doing it for you. So that was a look there. And then here are the other ones. We do a lot of these condors and butterflies. And so on this one, you can see here's our current updated, again, unaudited. So from this part of the service started back in May of 2019. We've had 231 trades closed out, 167 winners, 17 break even, 47 losers. So running around a 79% win rate. Now these are potentially huge winners, anywhere from 2 to 1 to 25 to 1, and very low risk type spread trade setups. Okay, so these are the condors and the butterflies, and we do a lot of these condors and selective butterflies as well. So here's one that we did recently. This is on Palantir, PLTR, and so here I'll just kind of go through these. I'm not going to spend a whole lot, but you can go back and look. So here was set up on the 13th. It was traded at 123, and so this was fairly short duration to the 16th, and traded at 128.88. So it says I had to send out a correction, but new Palantir trading at 123. I go through what the trade is looking like while I'm doing it. Was testing the weekly high, so we ended up doing this as a condor. So we did here is the 123, 125, and then had a credit spread side against it, 132, 134, and I set it up around $70. Okay, so that was done, and then you can see here on the 13th, now the trade was moving up. So we did an adjustment here, and then on the 16th, it was trading now at 128.94. And I say if long the spread, you're still in there, and we had adjusted this the 16 May 125, 127 call debit spread, short against that the 136, 138. So this trade then at that point, I was giving you an update, was up $128 or 177% return. So then I said, we'll follow up. So just kind of constantly giving you updates if you need to take profit, lock in some adjustments, whatever. And so Palantir we set up here, and then ended up here was kind of that trade profit take right there at the 128 level. So we did this long condor. Okay, so this was the 125, 127, and then we were short against that the 136, 138. So this is what that looked like, risk profile. Had done this for an adjusted risk of $72. Okay, so spread width 200 less the cost of the trade, potential to make 128 or 177% return. So condor. So these are great for this kind of market that we're in now, where you want to really keep your risk defined. And so this was the trade setup. We ended up in this at $72. Spread blew out to 200. So we got out 128. Max profit there. Okay, that was an example there of a condor. Here's just one more. This was one that we did on SPY, a put condor. And this one was a big winner. This one we set this one up. Originally, we set this up as a put debit spread and then adjusted to the condor. So it says new SPY reset short. It was trading at 568. And we bought this vertical debit spread, put debit spread, and then we adjusted it the next day adjusted it to a put condor. When it sold off real hard, we adjusted this to the put condors. We had reduced our risk to super low. And so this was, it was going into the expiration on the 11th. And now this trade based on our adjustment was up $205 here, which was a 476%. And then towards the latter part of the day, now it was up trading at 558, and now it was up 257 per spread, or over 597%. So these are the types of trades that you can look for out of the alert service, or do it. A lot of people just do their own thing, but here's the trade setup. We went short here. We adjusted it here and then took profit. And this was just a really quick in and out trade. This thing lasted only one day, but it was a super big winner. So 563, 560 put debit spread. And then we did the other side when it moved down real hard. We added the bull put credit spread, the 550, 547 here, and reduced our risk to $43. And so potential profit, if it went out there at expiration the next day, was for $257, 597% return. And that's pretty much where that ended up. So it went out right there, and it ended up perfect right there in the middle. Took our profit off there. Now we're taking profit at different times, but this is where it was at that point in time. So now it's trading at 556.97. So the spread blew from $43 out to 300. So that was that trade set up there. And then the other part of the service, from time to time, we'll get some really selective trades. These are what we call our lotto ticket. These are butterfly type pinning trades that from time to time we'll all spot a good opportunity, and these are really fun. Here's one that we did on SPY. This was a put butterfly pinning trade, and so you'll learn what that is and the service and stuff. But this is one that you can kind of look at what we did. So SPY is trading at 573.80, and we set this one up for a pinning trade. You can see here it says new SPY pinning trade, trading around 573.80. This is what we call binary put butterfly, because it's either you make it or you don't, binary. So because they're super low risk, so send out, say, buy a butterfly here, the 560, 560, 55, around 40 cents or lower. So the debit paid will be your risk. Okay, so binary trade. And then here it was on the 10th. Now it was trading, I said expires today. I said now it's trading around 567. If long the butterfly, look to take profit today on any move lower towards 560. And then I sent out another updated alert here. It says now it's trading at 561. If long the put butterfly, make sure to take profit today, close out the trade. Currently up $232 a spread, 595% return on that butterfly. So that was one that we did. And then here's another one. So here was the short trade set up, and here it was going out, pinning pretty close to where we, we're looking at to go. And so here was the trade structure. So this was doing the 565, 560, 555 put butterfly like this for a $5 wide spread for a total cost of 39 bucks. So potential profit, if it went out at our top of our tent, the body was 461, over 1100% return there on that type of trade. And went out pretty close to it. It went out up at 460.32. Now we're taking profit scaling out, but here's where it went out. So it was a perfect, pretty close to a perfect pin. So towards the end of the day, it was right about here. So that spread blew from 39 bucks to 456. So it was up 417 or over 1,000% return. So that was a put butterfly. And then this one was another one that we had done. This one was this one was perfect, actually. This was on Tesla, so I love this one. This was another one, kind of the put binary this was a call butterfly, but it was trading at 189.35. So we're on this one, we were looking for a move to 200 for a pin. And so this had a potential to be up over 1,900%. So set this one up. Look at the risk on this. The risk on this when I sent out was $12. That's why this was so huge. So this was doing a 197.5, 200, 202.5 call butterfly for 12 bucks. I said to get it on around 12 bucks. And then here it was on the 16th. Now it was trading up there at 200. That was our target. So it was now up $215 per spread on risk of 12 bucks, over 1,700%. And then at the end of the day, I said, wow, almost perfect pin. Actually, it was perfect. And so now it's up 230, up over $1,900 on that spread. So, these are the kind of trades that we're trying to, put together and that you can expect to look forward to. And so here's getting in the butterfly, here's taking it off, and here was the spread, 197.5, 200. And just think back though on that KRE made over 1,800 on that on a return. So here's the butterfly there, $2.5 wide butterfly spread, risk of 12 bucks, 238 potential return, and it went out pretty much right there at expiration, right there. So this was at 238, 1,983% return. And just kind of, so these are some of the deals and things you'll get. And again, here's just kind of an outline of what you're going to receive here today. Just make sure to put in powercycletrading.com/special, click on that, or copy and paste it and then put earn 15 and you're ready to go. And looking forward to seeing everybody, guys and gals, next weekend for the course that will start on Saturday. Okay, so just like to say thank you very much for being here. And again, here are all the different additional bonuses you get. So the course today, if you use that link, will be 167. You're going to get my on-demand earnings course. You're going to get my trading club trial membership for 30 days, my start trading options, the follow-up dedicated Q&A, my Greek course on the Greeks, and the 3 trade lists that we'll be using. So total course value of over 2,600. And if you use that promo code today, earn 15 and powercycletrading.com/special, you'll get everything there for 167. And then if you want to add the elite alert service for 4 months, plus the trading club for 4 months, you can do that today and get all that for 507 if you do the earn 15. Okay, so that's everything there. And then, just go into that payment link that you have, and that's all you need to do. So just one last time there. If there are any questions, please let me know. And I appreciate everybody spending a little bit of time here today, and hopefully this is stuff that you can use, start using next week, for the earnings trades that are going to start kicking off. Okay, so course package 1, today 167, just click on there, put in that earn 15 if you want the alert service with it for the next 4 months plus the trading club. Click on this down here, course package 2, and if you want my indicators, you can also have those. Those, when you check out, those will be added to it as well. All right, well, I'd like to say thank you everybody so much for being here again.